The mortgage underwriting and appraisal process. Congratulations on moving on to the next phase of the home buying process. The aim of this presentation is to educate you on the two most important steps associated with obtaining a mortgage: the mortgage underwriting and real estate appraisal. What is underwriting? Mortgage underwriting is the process a lender uses to determine if the risk of offering a mortgage loan to a particular borrower under certain parameters is acceptable. Most of the risks and terms that underwriters consider fall under the 3 C's of underwriting, these being credit, capacity, and collateral. Basically, to help the underwriter assess the risk associated with the loan, banks and lenders create a set of guidelines that take all your information into account and analyze the various aspects of the mortgage and provide recommendations regarding the risks involved. It is, however, always up to the underwriter to make the final decision on whether to approve or decline a loan. Important parts of the underwriting process include your credit report, your income, your assets, and the final approval decision. Your credit report is what a lender will use in order to review how you have managed your bills and debt in the past. The lender will receive your credit report from all 3 of the national credit bureaus. It is by looking at your credit report activity that the lender will be able to see the probability of whether or not you will default on a mortgage if offered one. Another facet of your credit report is the credit score. This is a calculated score that shows how well you manage your current or past debt. It is calculated based on longevity, payments, and amount of debt carried. A lender will look at how you make your payments, if you have had late payments, defaults, or bankruptcies. All of the above are taken into consideration when your file is going through the underwriting process. Your level of income and the stability of it will determine to the lender whether or not you are able to afford the mortgage loan repayments that need to be made. So, the amount that you receive in income is important, as is the stability of the income you receive. Being at your job or running your business for a period of 2 years or more will usually show a good probability that the income will continue at its current level or will steadily increase. People who are employed by a company and who have an hourly rate of pay pose the lowest risk in the eyes of a lender or underwriter, while self-employed pose the highest. This is according to underwriting guidelines. In order to prove your income, you will need to provide the following documentation: your 2 most recent pay stubs, W-2s for the last 2 years, your tax returns for the last 2 years, and your 2 most recent bank statements. Let's talk about the debt-to-income ratio. Your ability to pay the loan back is calculated using a method known as the debt-to-income ratio. This is calculated by adding up all of the monthly liabilities and obligations such as mortgage payments, credit and loan payments, or child support, and dividing those by the monthly income. Assets are an important consideration when evaluating your capacity to repay a loan. Borrowers who have an abundance of liquid assets at the time of closing statistically have lower rates of default on their mortgage. This money is usually called reserves. For example, if your total mortgage payment is $1,000 and you have $3,000 left after you pay your down payment and closing costs, you have 3 months of reserves. Underwriters also look closely at your bank statements for incidences of NSFs, non-sufficient funds. If this happens regularly, this is a red flag with the underwriter because this indicates that the borrower doesn't know how to manage their finances. The final approval decision. After reviewing all aspects of the loan application, it is up to the underwriter to assess the risk of the application as a whole. Each borrower and each application is different, and many borrowers may not fit every guideline. However, certain aspects of the loan may compensate for lack in other areas. Let's talk about the real estate appraisal. A real estate home appraisal is simply that, the expert opinion of a certified, state-licensed professional who determines the value of a piece of property. This is an important step in getting the finance that you need. A home appraisal protects the bank from getting stuck with a property that's worth less than they've invested, and it protects you from paying too much for a house simply because you're emotionally invested in the process and love that house. The home appraisal is a no-nonsense factor in a decision that is often an emotional one for the buyer. When you apply for a mortgage, your lender typically requires the property to be appraised by one of their approved appraisers. It is very important to make sure that the appraiser is properly certified and licensed in their relevant state. You usually pay for it as part of the mortgage cost at the time of closing. The cost typically is around $300 to $500, but can be more depending on the price of the property. It usually takes a week to 2 weeks for an appraiser to do the appraisal and then return the report to the lender. This sometimes causes a delay, however, this time frame is typical. In closing, we hope that you've enjoyed this presentation and that it has assisted you in understanding the underwriting and appraisal process a little bit more. We'll see you at the closing table.